Gold surged past $5,300 on February 28, 2026. Then it dropped below $5,050 just days later. And now, with a war actively burning in the Middle East and the Strait of Hormuz reportedly closed, gold is falling. If you hold gold right now, you need to understand exactly why this is happening, because the next move could be violent in either direction. Welcome to Capital Anchor. I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, subscribe right now because what I am about to show you could completely change how you see gold and what it does next. So let us start with the facts on the ground as of March 5, 2026. On February 28, coordinated U.S. and Israeli military strikes hit Iranian targets. Gold futures surged over 2% in a single session, jumping from approximately $5,100 to above $5,300 per ounce. That is a $200 move in hours. It was one of the largest close-to-open gaps in gold since late 2025. Then something unexpected happened. Gold reversed. By March 3rd, spot gold had fallen 3.6% to $5,137 per ounce. U.S. gold futures settled 3.5% lower at $5,123. And at one point during peak chaos explosions in Tehran, a reported closure of the Strait of Hormuz, crude oil jumping over 8% in a single session. Gold briefly fell below $5,050. Think about that for a second. The world's most important oil choke point was reportedly shut. Crude oil spiked. Iran and the United States were in an active military confrontation, and gold was going down. Most retail investors saw this and panicked. They thought the trade was broken. They thought gold had failed as a safe haven. But that is not what was actually happening. Here is the hidden mechanism that most people completely missed. Think of gold and the US dollar like two people on opposite ends of a seesaw. When one goes up, the other almost always comes down. That relationship is one of the oldest and most consistent dynamics in financial markets. When the Iran conflict escalated, it did not just trigger fear. It triggered a flight to liquidity. Investors did not run to gold first. They ran to cash, specifically to US dollars. The US dollar index surged, approaching levels near 99.57, the highest since December 2025. That single move pushed gold down, despite the geopolitical fear, because a stronger dollar makes gold more expensive for buyers using other currencies. International demand drops, prices fall. Bob Haberkern, senior market strategist at RJO Futures, described it precisely. The move lower in gold appeared to be driven by a flight to liquidity, a flight to cash. That is the mechanism. That is why gold fell while the world was on fire. Now let us go deeper on the three reasons this happened. Reason number 1. Dollar surge absorbed the safe haven bid. When geopolitical shocks are severe enough, the US dollar and gold compete for the same pool of fear capital. In moderate crises, gold wins. In extreme liquidity crises, the dollar wins first. What happened on March 3rd was an extreme moment. Oil spikes, war headlines. Hormuz closure. Investors needed liquid, tradable assets immediately. U.S. treasuries and the dollar are the world's most liquid assets. Gold lost the initial round to its own competitor. Reason number 2. The Iran conflict pushed rate cut expectations lower, not higher. This is the counterintuitive part. Gold loves low interest rates because it pays no yield. When you can earn 5% on a treasury, the cost of holding gold is high. When rates drop, gold becomes more attractive. But this conflict injected a new problem. Energy prices spiked because of the Hormuz situation. That raised inflation expectations. Higher inflation means the Federal Reserve is even less likely to cut rates in the near term. Suddenly gold had a weaker monetary tailwind precisely when the geopolitical tailwind kicked in. Damage to energy infrastructure and stalled tanker traffic through Hormuz lifted the risk of sustained strength in oil and gas, stoking inflation fears and pushing back rate cut expectations, leaving gold with reduced monetary support at the worst possible time. Reason number 3. Profit-taking after a historic run. Gold had already gained approximately 22% year-to-date before the February 28 conflict escalation. Spot gold has gained 19% just since the start of 2026. Silver was up over 16% this year. These are historic gains. When gold hit above $5,400 a week before the March pullback, institutional traders had massive profits locked in. The conflict gave them the perfect high-volume exit point. Retail investors were buying the fear. Institutions were selling into it. That is exactly the big player versus retail disconnect you need to understand. Here is what was really happening while mainstream media was running headlines about gold surging on Iran fears. While retail investors were buying gold because of war headlines, institutional traders were booking profits into that same fear spike. While you were reading about safe haven demand pushing gold higher, the US dollar was quietly becoming the actual safe haven of choice for the first 72 hours of the conflict. And here is the biggest disconnect of all. Major institutional forecasts were not changed. JP Morgan has a $6,300 per ounce target for gold by December 2026. Deutsche Bank reiterated $6,000 per ounce on February 2nd. Wells Fargo lifted its year-end target to a range of $6,100 to $6,300. Morgan Stanley said if geopolitical tensions remain elevated, gold should catch up to $5,700 per ounce in the second half of this year. These institutions were not panicking. They were watching retail investors panic and doing something completely different. Metals Focus, the British research firm that has been tracking gold markets for decades, still sees significant upside for gold in 2026. The firm sees this pullback not as a trend reversal, but as the kind of short-term correction that has repeatedly appeared and disappeared throughout gold's long-term bull run. While retail investors were questioning whether gold's safe haven status was broken, central banks around the world were continuing to buy. 95% of surveyed central banks expected global gold reserves to increase over the next 12 months. These are not traders reacting to a Tuesday headline. These are sovereign institutions making multi-year strategic decisions. And that is precisely where this story becomes more than a war trade. But here is what most people have completely missed: the real reason Metals Focus is still bullish has almost nothing to do with Iran and everything to do with a structural shift that started long before the first missile was fired. Let us go back to 2022 for a moment, because history is about to rhyme in a way that should make every gold holder pay close attention. In March 2022, Russia invaded Ukraine. Gold surged past $2,050. Then it reversed sharply, dropping back to $1,890 within 2 weeks. Retail investors declared the safe haven trade dead. Financial media called it a failed breakout. What happened next? Gold spent the following 24 months building a base, and then exploded to $3,500 by mid-2024, eventually reaching $5,300 by early 2026. The pattern is identical to what is unfolding right now. A geopolitical shock, a sharp surge, a confusing reversal, retail confusion, and then, for those who understood the fundamentals, a continuation of the larger move. The conflict was a catalyst, not the cause, and the cause is still completely intact. Now let us talk about what has not changed, because this is where most people lose the thread. Structural factor number 1. Central bank buying remains at historic levels. Since 2022, central banks have purchased over 1,000 tons of gold per year. This is not panic buying. This is a deliberate, multi-year reallocation away from US dollar reserves. That trend did not pause because of a 3-day gold price reversal. Structural factor number 2. The de-dollarization trend is accelerating. China, Russia, India, Saudi Arabia, and over a dozen other nations have reduced their US dollar reserve holdings since 2022. Gold is filling that gap. The BRICS bloc alone represents over 40% of global GDP. Their shift toward gold-backed settlement frameworks is structural, not cyclical. Structural factor number 3. U.S. fiscal deterioration is irreversible in the short term. The U.S. national debt crossed $36 trillion in early 2026. The federal deficit is projected at $1.9 trillion for fiscal year 2026. Every dollar of new debt issued dilutes the real value of existing dollar holdings and strengthens the long-term case for gold as a store of value. Structural factor number 4. Institutional positioning is still building, not unwinding. JP Morgan, Deutsche Bank, Wells Fargo, and Morgan Stanley all hold year-end price targets between $6,000 and $6,300. These are not retail guesses. These are models built on supply, demand, monetary policy trajectories, and sovereign buying data. None of these 4 factors changed on March 3, 2026. Not one. Now, on the record, screenshot this. Gold will reach $5,800 per ounce by June 30, 2026. Here is why. The Iran conflict has injected a sustained energy price floor. Oil remaining above $90 per barrel will keep inflation elevated through Q2. That delays Fed rate cuts further. But here is the twist: delayed rate cuts extend the period of uncertainty, and uncertainty is gold's single greatest long-term driver. Meanwhile, central bank buying in Q1 2026 is already tracking above the 2025 quarterly average. Physical demand from Asia, particularly from China and India ahead of Q2, is running at levels 18% above the same period in 2025. The dollar surge from the conflict will fade once the immediate liquidity panic settles. And when that seesaw tips back, gold will move fast, $5,800 by June 30th, on the record. Now let us talk about probabilities, because not every scenario plays out the same way. Scenario 1. The Iran conflict de-escalates within 30 days, the dollar softens, and Fed rate cut expectations return for Q3 2026. Gold recovers to $5,600 by late April and pushes to $5,900 by June, probability 55%. Scenario 2, the conflict drags on past 60 days, oil stays elevated, above $95, inflation expectations spike further, and the Fed signals it will hold rates through year-end. Gold consolidates between $5,000 and $5,300 through Q2 before breaking higher in Q3. Probability 35%. Scenario 3. A rapid escalation pulls the U.S. into a wider regional conflict, the dollar surges past 102 on the DXY, and gold temporarily drops below $4,900 before institutional buyers absorb the dip and drive a violent recovery above $6,000 by Q4, probability 10%. In two of those three scenarios, gold ends significantly higher than where it trades today. The only question is timing. Now let us get practical, because different people watching this are in very different positions. If you are holding physical gold, do not move. This pullback from $5,300 to $5,050 is not a structural break. It is noise inside a bull market. The fundamentals that drove gold from $1,800 in 2022 to $5,300 in 2026 are still in place. Physical holders should treat this as confirmation, not a crisis. If you are using leverage or actively trading, reduce your position size right now. Volatility during geopolitical events is unpredictable. And punishing for leveraged accounts, wait for the DXY to show a confirmed reversal lower before adding exposure. Do not chase the next spike. If you are sitting on cash and waiting for the right moment, this pullback to the $5,000 to $5,100 range may be the entry window. Metals focus and multiple institutional desks have been flagging. You do not need to go all in. A measured, staged entry over the next 30 days is more disciplined than trying to call an exact bottom. If you bought near the top above $5,300 and are now underwater, understand that the time frame matters more than the entry point at this stage of the cycle. The institutions forecasting $6,000 to $6,300 by year-end did not change those targets after the pullback. Your thesis is not broken. Your timeline just got a little longer. Now here is what to actually watch going forward, because the next 60 days will tell you everything. Watch the DXY. If the US dollar index fails to hold above 98 and starts rolling over, that is the first signal that the gold recovery is beginning. A DXY drop toward 95 would be historically consistent with gold adding $200 to $300 per ounce within 60 days. Watch COMEX gold inventory levels. If registered gold inventories start declining sharply, it signals physical delivery demand is outpacing paper supply. That is a deeply bullish signal that retail sentiment cannot manufacture and institutions cannot fake. Watch the next Federal Reserve meeting minutes and any commentary from Chair Powell on inflation versus employment trade-offs. Any language suggesting rates will stay higher for longer is short-term bearish for gold but medium-term bullish as it confirms monetary uncertainty. Watch central bank purchase reports from the World Gold Council. If Q1 2026 buying exceeds 290 tons, it will confirm that sovereign demand is accelerating into the pullback, exactly the behavior that preceded every major gold rally in the past 4 years. Now, as we get to the end of this, I want to talk about Three types of people watching this video right now. The first type is panicking. They saw gold drop $250 in 3 days. They are reading headlines about failed safe haven trades, and they are seriously considering selling. These are the people who will sell at $5,050 and buy back in at $5,700, wondering every time why they always seem to be on the wrong side. The second type is frozen. They know gold is in a long-term bull market, they believe in the fundamentals, but the volatility has them paralyzed. They cannot buy, cannot sell, and they are just watching. These are the people who will miss the next entry window because uncertainty felt too uncomfortable to act in. The third type is the one watching this channel to learn and prepare. They understand that a $250 pullback inside a $3,500 rally is not a crisis. It is a test of conviction, and they are using this moment to position, not to panic. Markets do not destroy wealth, they transfer it, from the impatient to the patient. From the uninformed to the prepared, from those who react to headlines to those who understand mechanisms. Every time gold pulls back like this, the same transfer happens. The same people sell to the same institutions that have been accumulating since 2022. Gold surged past $5,300 on war headlines and then fell below $5,050 while that same war was still happening. That is not a broken trade, that is exactly how major bull markets shake out the weak hands before the next leg higher. If this breakdown gave you clarity, hit the like button right now. Subscribe to Capital Anchor so you do not miss the next video when gold makes its next move, and send this to one person who is confused about why gold fell during a war because they need to understand this before it is too late. Drop one word in the comments that describes how you feel about gold right now. One word. Let me see where your head is at. For informational purposes only. This is not financial advice.